IFA Galaxy for giving us this opportunity to present views of the debt. Just using Ashish's presentation about storytelling, I think last 1.5 years in debt, especially in credit, the story is all about risk management, right? In debt funds, risk management last 1.5 years has been tested and has been tested quite well. And we've seen what kind of an impact it has had on funds performance, or what kind of an impact it has made on funds. So from our perspective in HDFC Mutual Fund, what we feel the key is risk control. How we control risk, how we manage risk, that is the key as far as debt products are concerned. So we start with in-depth credit assessment, wherein you analyze or do in-depth credit research on the company, and we follow a very simple framework which we call SLR, wherein S stands for safety, L is for liquidity, and then returns. And we prioritize in that order, where safety comes first, safety is paramount, safety cannot be compromised with, then comes liquidity, and then finally returns. And we have seen that over the years, things will be going fine. Up until, September 18, things were going fine in the markets. Then we had IL&FS issue and the whole scenario changed. So we've seen that in credit investing, prudent risk management holds the key. And if you can control and manage your risk well, then you can come out quite good. Now, at HDFC, for us, how do we go about managing risk? There are 3 key aspects. The first one is the risk assessment. Here we use 4 C's of credit. The second aspect is risk mitigation, how we control and how we manage the risk underlying in each investment. And then finally, risk pricing. Are we getting compensated well for the kind of risk we are taking, or are we not? And in order to do credit assessment, in order to do credit research, we follow a very simple model which for credit, which we call the 4 C's of credit. And following this model of 4 C's of credit has helped us out tremendously in the last 1.5 years. The first most important C of credit is character of management. The only reason why we never invested in Dewan Housing was because we were not confident about the promoters' credibility, promoters' credentials, and character, so to speak. So that helped us out to avoid an exposure like Dewan. Capacity to pay is the second important C. When you are looking at any company or business group, what kind of size of cash flows the group is generating and what is the quantum of debt to be serviced. And this C helped us out avoid IL&FS exposure. Why we were not in IL&FS group? Because we thought the cash flows which the group had were not enough to service the kind of debt which the group had taken on. So the capacity was not good enough. The third important C is collateral. Now, collateral is nothing but the security which we get when you give any company some debt. This is the security which is pledged with us. Now, you all would have seen that at one point HDFC had very large exposure to SL Group. We had 1,000 crore plus exposure in SL Group, but we were able to recover everything because the collateral was very good quality Z Entertainment shares which were backing the debt. So we came out unscathed because of the sound collateral, because of the solid security which we had. The final C is covenants. Now these covenants are nothing but the terms and conditions which we have when you invest in a company's debt, and we lay a lot of emphasis on these covenants, and they have helped us out in the past. You know, we had at one point of time, we had huge exposure in microfinance sector. Then we decided that we are not comfortable with our exposure in MFI companies and we want to get out. And we use some of these covenants to ask these companies to repay our debt even before maturity. So this C helped us out in reducing exposure, in getting out of risky sector. And you know, over last several years, this simple framework of concentrating and looking at the 4 C's of credit and evaluating our company or any investment, looking at these 4 C's of credit has helped us out tremendously. And once we decide that yes, we want to invest in a company, how do we decide what size of exposure should I be taking? And we have seen last 1.5 year, number of fund houses have gotten into problem because the size of exposure which was there on the fund was very large into some of these names. But what we follow is to have our own credit scoring model. In the model, we will feed what is the parentage, what is the financials, what is our internal rating on the group. If the company has an external rating of AAA, but we feel that the company deserves a AA rating, we take that internal rating into account and what is the outlook. After putting in all this data into the model, you come up with a credit score, and based on the credit score, you decide what size of exposure I want to take on a particular company. What this does is controls the risk. Your size of exposure is in line with the credit fundamentals. So if a company is large in size, company is doing well, if it has a strong parent, only then it qualifies for a 10% exposure. But if the company's fundamentals are not that good, if the size is small, the exposure which is allowed is much lower. It will be 5% or maybe 3% or maybe 1.5%. So what this has done for us is that ensured that the portfolios have become very well diversified. They are diversified not only in terms of issuers, they are diversified across business groups, they are diversified across different sectors. Now, in the last few years, we have seen that banks have had large amount of NPAs, right? They peaked out at over 15% in FY18, but mutual funds have been much less affected. If you look at the size of the mutual fund industry in terms of the debt exposure and the quantum of names or assets which have faced some kind of a credit event, the proportion which mutual funds have faced is far less. But even then, in the last few years, we've seen large number of, at least 15, 16 companies or groups which have come under some kind of stress. And we've seen from 2010, if you go back, it started the Deccan Chronicle, we had Amtech Auto, Jindal Steel and Power, Ballarpur Group, Religare, Dewan Housing, ILNFS, Cafe Coffee Day, latest being Voda Idea. Now, thankfully, we have been able to avoid all these large credit events or credit stresses, which the mutual fund industry has taken a hit on in the last few years. Thankfully, we've been staying away. We've had our own share. It is not as if, any credit event has not touched us. I think nobody in the industry has been spared in the last 1.5 years. We've had our own share with Z Group. We've had some problem with a small exposure in ITNL based SPV. But thankfully for us, the credit cost on an overall basis in the looking at the size of funds we manage has been absolutely small. It has not made any impact overall on our fund performance. And the only reason for that is that because we have been able to manage and control the amount of risk which we have taken. So that has been the key for us. And now going forward, I think the view which we have is that the worst phase of credit stress is behind us. We feel that today credit spreads are high, worst phase is behind us, and therefore there is an opportunity to take advantage of this. We've seen post-island affairs, if you see in the lower chart, the red line, the AA spreads have widened significantly. The AAA spreads, on the other hand, have been almost flattish, while AA spreads have widened significantly. So we feel there is a great opportunity at this stage to consider credit as an investment opportunity because spreads are high, there is enough value out there, and the environment is improving. If you look at the situation which the NBFC sector was having, say just 6 months or 12 months back, the kind of liquidity freeze which was there is no longer the case. We are seeing companies going overseas, raising ECBs, they are doing retail issue of NCDs, securitization is happening. So overall liquidity scenario has improved significantly, and therefore we feel that the worst phase is clearly behind, the spreads are high, and therefore it makes sense to consider investment into the credit space. Now, just to sum up, I think this is what Howard Marks has said. We thought it was very appropriate. Risk control is the best way to avoid loss or loss avoidance. Risk avoidance, on the other hand, is likely to lead to return avoidance. So, if investors have to earn some return in life, there is no way you can avoid risk. You have to take some risk in life, and we've been seeing last 1 year, last maybe 18 months, investors are scared of credit, and credit has become a bad word, but I think it is getting overdone. The situation is not as bad. It is time to take some measured amount of risk and generate some return. We think, the time to invest in credit is now. We think the spreads are high, the spreads are wide. Overall credit environment is showing some improvement. Our record has been good. So funds which have done well, funds which have demonstrated a strong track record can be looked at. And, in credit investing, whatever be the environment, whatever be the situation, people like us, fund houses who have been doing things in a very systematic manner will continue to remain even more prudent. There have been a lot of lessons which have been learned over the years, and we think that going forward, the kind of intense credit stresses which have been faced will no longer be the case, and the next 2-3 years definitely should be a significantly better period for investors to earn returns. Just to summarize, I think on the rate view, if I have to take 1 more minute, which I have, I think tomorrow is the budget. Market is waiting for the fiscal deficit number eagerly. Most likely the fiscal deficit target will not be met. 3.3 could go to 3.8. So there is a possibility that in the coming year, because of fiscal being eased, because fiscal deficit going to remain high, inflation taking its time to come down, RBI may not have much room to cut rates further. We think that yields could remain in a range bound manner. We think that duration as a strategy going forward may not be as productive or as remunerative. So therefore accrual makes much more sense, and we feel this is the right environment to look at shifting maybe from duration space or purely duration or AAA some amount into the credit space and earn some good returns. That's all from my side. If we have time for questions, I'm open to that. If we don't have time, we can move forward.
Thank you so much, Shobhit.